I got this idea, theme, concept from Cliff Asness, a very well-known hedge fund guy. He wrote a paper in the around 2017, talking about constraints on capital. And he talked about how forced investment in one way or another, whether it's through regulatory pushes or incentives or subsidies, it results in misallocation of capital and overall malinvestment. In other words, you're forced to buy this on some incentive, or you're forced to invest here because some subsidies have made it easier, to do that. And this always results in opportunities. Basically, you have overreach, overinvestment, and you have underinvestment in other areas. And this is sort of, to me, always where opportunity lies.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Boehm. Today, we're fortunate to have with us Mark Neuman. Mark is the CIO of Constrained Capital. He is the ESG Orphans Index creator and a CFA charter holder. He is a 30-year Wall Street veteran, former global equity derivatives trader with Merrill Lynch, Susquehanna, Jones Trading, and Baycrest Partners. Mark, thank you so much for joining us today.
Thanks, Gary. Glad to be here.
So let's begin with how you see the current state of the markets and the economy.
Sure. It's a really interesting time right now, especially in the lead up to the election, which is not 6 months away. There's a lot of, I wouldn't say necessarily unprecedented, but there's a lot of very interesting developments that definitely make this sort of somewhat unique, although things sort of repeat themselves over time. The concentration of the big six or so in the market is reminiscent of, the 2000s, the run up into 2000. So we're at a spot where I would say those with a long enough memory, or those old enough like me and potentially you, I guess, remember how things were and, how things are cyclical. And, we're in an interesting backdrop here in that the market's up about 14, 15% through the first half of the year. Very concentrated. I think about 60% of that number is from 5 or 6 names. Could be, you could probably pinpoint it on NVIDIA if you really wanted to get down to blame one or point to one thing. So, we're at an interesting spot here in that diversification probably makes a lot more sense than most people want to think about right here. I mean, as we headed into the end of the second quarter, I'm sure there were folks who were looking to put names on their sheets to show the board members of the various funds they run. Look, I own NVIDIA, I own Microsoft, I own Apple. And there's a bit of that still FOMO going on, people really afraid to miss those things or not have those names on their record. But we're at an interesting juncture here where I don't think, given all the moving parts on the macro side, I don't know how sustainable the pace of the first half will be into the second half. I'll say that with a modicum of cautiousness as we head into the second half of this year.
Okay, so we're going to get into that in a moment, but the market is currently about 2 times GDP. That's about equal to the ratio that kicked off the stock market plunge in 1929, the beginning of the Great Depression. For another comparison, the ratio was 1.5 times in 2000 at the start of the dot-com implosion. Mark, does this ratio matter, or is it very relevant and concerning to you, and why?
So I spent the first 7 years of my financial career in Japan. I was with Merrill Lynch in Japan in the mid-90s, post the bubble there in 1989, obviously. And they've always had a debt to GDP level over time that's been concerning, but they've managed to stave off the reckoning, if you will. I think that we are in an interesting time in the sense of, I don't want to cast dispersion on it, but financial innovativeness. Okay, I'll leave it at that rather than use the word chicanery. Where most countries that have their own currency are able to just keep printing to solve things. And I think that papers over a lot of the debt to GDP issue in the short term. there are those, particularly the modern monetary theorists, who believe the debt to GDP doesn't even matter. I think that's a recency bias or a help us with our bond position bias from those people. But I think that over time, this matters. It's just a question of how much and how soon. I really think that it's one of those things where if nobody's looking at it too stringently, then it's not a real discussion. If everybody turns their mind towards that one item, then it becomes a greater deal. And I think it becomes an even bigger deal as we look at the potential end of the 40-year soft interest rate cycle, right? I think that at very low interest rates, a debt to GDP number that's uncomfortable can be, almost kick the can down the road type thing. But if rates spike and continue to spike and hold up here, it sort of breeds another potential for crisis. I mean, there is talk that a lot of the banks are sitting on really bad numbers given the rate spike and how it hasn't come in, right? The rates haven't gone down. And you hear everyone clamoring for, we got to cut rates. I'm not so sure that those aren't the people whose positions suggest that they need to cut rates. Not in reality, we're at the middle of, we need too many indicators are still speaking firmly, hawkishly, inflation-esque, that the rate cut idea is too convenient, and it's to help people out as opposed to really be what I'd call prudent economic policy, so to speak.
So I appreciate that. And I'm wondering if you have an opinion on the size of the market versus the GDP instead of the debt versus GDP. The size of the market is currently rivaling the size of the market versus the GDP in terms of ratio prior to the Great Depression. So after the run up in the roaring 20s, the market exploded, the participation in the market exploded to the point where it was so heavily invested in that the scale of the market size was 2 times GDP. The last time it ran up in terms of scale, the market size, was the dot-com bust. Right before it jumped to 1.5 times the size of GDP. And it came down during that crash, and then it's been slowly going back up. So today, the size of the market participation is now at 2 times GDP, equal to just before the Great Depression. Do you have an opinion on whether that's a risk or not, that level of participation and scale of the market?
Right. So the way I look at this, Gary, is it's really an orders of magnitude progression. Okay. And I've seen an acceleration, and I'll explain what I mean. In 2000, CSCO was the biggest company roughly in the world, about $500 billion in early 2000. And we were looking at it then and sort of chuckling how it was going up $1 billion a day. Oh my God, $1 billion a day, Cisco. Well, now you got NVIDIA at $3 trillion, and it's going up $100 billion a day on some days, right? So this is, to me, the explosion in M1, in money supply, in all these things, so that really just tack on a couple zeros. It used to be the joke was a billion here, a million here, a million there. Pretty soon you're talking about real money. Now It's a billion here, a billion there. Then you're talking about real money. So I think it's really just an orders of magnitude thing. And look, I would attribute that to on the debt to GDP story that we're talking about here. We've never really cleaned out the rot. Okay, we've papered over it every time.
Yeah.
So back in 2000, and then in 2007, and then in the 2000, I don't know, the Silvergate, any of the big crises that have come up, there's never been a clean out, take this to zero, put a couple people in jail, just like, fraud is fraud, and let's clean it out and sort of start over. It's always been, let's paper over, let's give these guys some money and we'll trickle it down and everyone will get some more money and we'll just filter it through the system. You could even look, and I'm not saying we didn't need it, but the COVID loans and the PPP and all that, right? That was just, we have a massive problem. What do we know? Let's just give everyone a ton of money And then you see NFTs and SPACs and cryptos and all these things go nuts because money just finds a home. And so in the debt to GDP equation, the numbers just keep getting bigger and bigger, right? And that's just like, when does the rubber meet the road? I don't know.
Yeah.
You know, one of the interesting things I was looking at recently is the dollar strength that we've seen in the last month or two or three, as the yen has imploded, right? The yen is going to like 160, 165. And as a guy who lived in Japan, I keep a close eye there. And then you have the euro, which has actually recently strengthened a little bit, but the dollar, the euro, and the yen, those are the three pillars of the, I don't know, let's call it maybe the Western currencies, if you will. In a world of which one's last standing, I'm going to bet on the dollar. I can't see the reason why the yen or the euro would actually strengthen. So I take that dollar survival, cleanest shirt in the dirty pile or whatever we say, and you look at that versus the debt to GDP. Those are two things that sort of are counterintuitive, right? You have that debt to GDP out there, and you have the dollar as the last bastion of hope or strength. So somewhere down the road, this all matters. And look, I think a big crux of this is what happens to interest rates. I do, because we had that 40-year lower, it touched zero. And now it's rallied here a bit, and expectations are, we need a cut. The people who say we need a cut are the people who are really scared about that to GDP, in my opinion.
So, Mark, we saw a very strong market in the first half. It surprised a lot of people. But now many experts are saying that dynamics have shifted clearly. Okay. Do you agree with this sentiment? And in your analysis, what dynamics have shifted, and are you looking for a weaker second half here?
So on the weaker second half, I start to wonder where that is in consensus, right? Because everyone seems to be focused on the same thing now. In terms of like, we have earnings coming up in like the next few weeks, right, for Q2. AI has been the driver. It's no secret to anybody. And as I said, with the explosion in NVIDIA, for example, a couple months ago, I got to say it was the fall or maybe the last couple of months of 2023, I looked at these big tech 5 or 6, and they were like 9 trillion in market cap. Now they're 14 trillion. Like, what is going on? And so, in terms of expectations for the second half of this year, the election notwithstanding, which arguably could be the most important election we've had in 200 years in this country, I don't know. All that aside, right? There's massive fundamental shoes, thanks to AI, that all these companies have to fill now. And I remember, I don't hate to sound like the old codger, but like, Cisco and Microsoft in 2000 were the biggest companies. Their revenues went up 4x over the next 15 years, 2000, 2015. 4x jump in revenues. Microsoft was flat, and Cisco went down 50% in that time. So, there's a lot of parallels. It sounds like we're just going gangbusters, and it's okay that the 3 or 4 or 5 biggest companies are so tightly aligned with the government on some level, and info share and data scraping. I just have a feeling that things don't always work out as they should. And look, we haven't even touched on it. I don't know how we'll get to it. I don't really need to get into the politics of it all, but like, we have 2 80-year-old people that very few people trust. One of them is potentially going to be the leader of our country. So I don't know how volatility has stayed as capped as it has for this long. So that's something I towards the second half of the year end, I just think that there's a lot of cheap insurance to be had, in terms of protecting. And look, I always say, if you have a portfolio without a hedge, you don't have a portfolio. You just have the market. And that's fine. It's worked. Just have the market, be long, no hedge. Okay. But for me, that's not the way I would run. That was not the way I'd protect my wealth here to the year end through that election. Yeah.
So, Mark, let's talk about inflation for a moment. Do you see inflation as being on the road to being stamped out by the Fed, or do you see it as being more entrenched like the 70s and 40s? What are your inflation expectations, and what do you base those expectations on?
Okay. So last summer I had the fortunate time to spend a couple days at a, I don't know, economist sort of nerd camp, if you will, up in Maine. Pretty well known collection of guys. There was a ex-Fed governor there, and we had a talk, and we talked about inflation versus the cost of living. And this is really important, Gary, I think, because I view, and I mentioned this to this gentleman too, inflation, in quotes, right, is a word that the Fed guys, Fed governors, excuse me, men and women, the Fed folks, discuss over like iced tea and noodle salad, right? Like, hey, inflation, I don't really see it. Do you? No, it doesn't bother me. And so that's what they talk about. And the dot plots, which everyone focuses on, okay? That's those guys throwing a dart out on the calendar a year from now. Some of them are not even voters when that time comes. So like their opinion is what we're talking about. And they never really talk about cost of living, okay? I do the shopping a lot in my house. My wife works, I work, but like I go to the shop. I like food, so I do the food thing. Eggs, milk, butter, bread, meat, whatever, those are all up. Okay, up. I don't really care what the inflation numbers say. The cost.
Did you have? I don't mean to interrupt, but did you happen to see the video that kid did? He had ordered some stuff on Walmart a couple of years ago during COVID. Went back to his cart because he needed to get something and thought, I wonder what these items cost today. So he literally ordered the same items. They had cost about $125 when he ordered it during the COVID shutdown. Now it's over $400 for the same items.
That's exactly right. So again, inflation, cost of living. The inflation is a discussion that we try to base policy on and talk about it. Like I said, I sort of joke, over the water cooler or at the noodle salad lunch with iced tea. Okay. But when you go to shop, you spend on gas, you spend on, I got a son going to college next year and my kids, whatever.
Right.
Those prices aren't coming down. So maybe a phone is cheaper or a laptop could be cheaper. So if you sit at home and you want to sit on the couch and do nothing, well, that's cheap. But if you want to do anything to advance yourself, make yourself healthier, make yourself better, those are all costing a lot of money. So when we talk about inflation versus, like I said, cost of living, I think there's a big distinction. Now, what we as market watchers, participants, we care about what the inflation discussion is and what it implies for the rates and rates movement. I think we are in a stagflation environment. I think it's 1970s-esque. You're going to get stubborn, sticky, high prices, and you're going to get dampened growth. There's so many things that are deflationary in the labor and the working market, if you will. AI is definitely going to be deflationary. If you can pay 10 robots to do what 25 people could do, well, the robots don't buy anything. They don't have to pay healthcare, so that's that's a deflationary aspect.
Never a sick day.
And never a sick day. You can refresh the batteries, and you're good. And then there's a lot of people out of work now, right? So where does that play out? Well, there's a lot of deflationary forces. There's a lot of inflationary cost of living forces that we deal with on a daily basis. So when you put those two together, for me, I think it's stagflation. And again, back to they're going to cut rates and this and that. To me, those are people speaking their positioning, not speaking their economic observation. Because look, let's remember, stagflation is the most impossible setting for a central bank. You can't cut rates, you can't raise rates. Like, what do you do? And then you have, I don't want to get too into it, but you have Janet Yellen, ex-Fed chair at the Treasury, and they're two heads of the same animal trying to dance around the inflation story, I guess.
So there's a lot to unpack on the inflation, the unemployment, what this means moving forward because of AI and robotics. I would love to have that conversation with you. And I think in the future, we should have that because I do think it's important. What I do want to do right here, though, Mark, is move over to constraints on capital. What does constraints on capital mean and entail to you?
Right. So, that's the name of my my firm. A while back, I got this idea, theme, concept from Cliff Asness, a very well-known hedge fund guy. He wrote a paper in the around 2017, talking about constraints on capital. And he talked about how forced investment in one way or another, whether it's through regulatory pushes or incentives or subsidies, it results in misallocation of capital and overall malinvestment. In other words, you're forced to buy this on some incentive, or you're forced to invest here because some subsidies have made it easier, to do that. And this always results in opportunities. Basically, you have overreach, overinvestment, and you have underinvestment in other areas. And this is sort of, to me, always where opportunity lies. I mean, I would talk about it in the sense of it's really about flows. And if all the flows are guided to one spot for some reason, and everyone's sort of piled in on that reason, you're going to get a stretched valuation, overextended situation. Whereas conversely, if all the money runs away from another area because it's villainized, it's shunned as a bad investment, or there's a bit of a, propaganda-like hit piece against a certain area, certain things, you get people to exit those areas. And to me, those imbalances caused by constraints are where a lot of opportunity lies in the market over time.
So that was a really good explanation on constraints on capital. So Mark, let's focus on the misallocations and the malinvestments for a moment in the marketplace. What are the dangers in those existing? The fact that there's misallocations and malinvestments, what are the dangers of that? What are some of the worries that you have because of the misallocation and malinvestment once the cycle begins to unwind? Like what do you expect to happen, not on the positive, but on the negative?
Well, if we get a bout of instability in the markets, people are going to end up selling what they own too much of, and they're going to sell what is the most liquid, right? So in recent market action, one of the big constraint on capital, in my opinion, in the last couple years has been ESG and the idea around it. And we can see now it's starting to unfold that guys like Larry Fink are saying, oh, ESG got too politicized. I mean, he's the guy who led the political cheer on ESG. We'll leave that aside. But a lot of money was under the guise of ESG pushed into certain names that really didn't end up qualifying as anything ESG other than getting a label of ESG. So, the 2015 to 21 roughly extensive run up, first wave, if you will, in the tech names, a lot of these tech names became ESG friendly, but they're not really ESG friendly, from Apple and Foxconn and Amazon and logistics and cardboard and, there's so many, but these all became the ESG darling investments. And that's why the top 5 or 6 constituents of the S&P and the QQQ look the same, because everyone launching an ESG fund, and hey, let's buy these, Amazon and Apple and Google as ESG. So those constraints pushed money, malinvestment, to those names and took money away from tobacco, alcohol, fossil fuel, nuclear energy. So the money was pushed to one side, and now that you see this Larry Fink throwing up the white flag on ESG, a lot of ESG questions, greenwashing, these kinds of things, it means that the universe that was originally excluded, alcohol, fossil fuel, tobacco, nuclear energy, are now okay again, or getting to be okay. So as that pendulum swings back, the idea of those sectors' names with a bit of a stranglehold on them become undervalued, underowned. They're still high quality companies that have been sort of left for dead, so to speak. So to me, that's where over time opportunity presents itself. And like I said, if we have a bit of a turbulent time, people are going to sell what they own the most of. And it's all those big cap tech. If they don't own the names that have been excluded, the names under the most constraint.
So the names that have been excluded, let's focus in on what's needed, like fossil fuels, nuclear energy, et cetera, for society. Those names that have been excluded for a decade plus, are you expecting massive price spikes in those areas because of the underinvestment?
So I would say that for a very long time, growth has been the story, right? That's been the winning trade for sure, without a doubt. The value side of the ledger has suffered because it's just not growing at 100% a year, let's call it, in terms of like a Nvidia or whatever. So I think that the fundamental nature of those exclusions, those you mentioned there, are good cash flows, dividends, stable companies, needed. We're going to need those regardless of what the pundits say, and they're underowned, and they are a good diversification tool. As we talked about a little bit earlier, owning QQQ or Nvidia, Microsoft, and Google, that's fine. You've done very well. I'm not taking away from anyone on that at all. But as you think about where things go and where things are, having a little bit of a high dividend, low beta, somewhat defensive, high cash flow, value aspect to your portfolio provides some diversification, provides what we call a barbell strategy. So you have some balance. And it's a way of really, if there's a liquidation event, those names are not held widely. And bigger names, Nvidia, Apple, Microsoft, et cetera, super liquid and very widely owned. So people are going to, if they need to raise cash, if there's a bit of a nervous spout in the market, then people are going to sell what they own and they're not going to sell what they don't own, obviously. So to me, that's where some of these exclusions, these ESG outliers, the orphans as I call them, will probably hold up better and probably could very well outperform.
So it sounds like you're expecting a reversal of to some degree in investment flows back into these sectors at some point. What do you see as being the catalyst that we'll say reverses the trend, when it started moving, when they started pushing ESG?
Right. So I look back to the fall of 22. Okay, that was before Putin invaded the Ukraine. That was at a point where the energy sector as a component percentage of the S&P was down around 2.5%, right? And that period from November to February, right, when Putin invaded, the energy sector, I think, was up. I don't know. I don't have my numbers in front of me. I want to say it was like 80%. It could have been, maybe it wasn't 80, maybe it was 70, but this was where the Amazon ExxonMobil trade blew out wide. In other words, Exxon ripped, Amazon came in. This was where the tech names, they were laying people off because they hired too many, and the whole ESG, DEI, like hire people, and then P&L suffered. But I think there's going to be a point where people realize, gee, fossil fuel's not going anywhere. We need that to heat our homes, to cool our homes, to do everything. And it's been villainized, for certain. It's been villainized, and we're starting to see little cracks in the facade about the story we've been sold and told being a bit more bureaucratically driven than P&L businessman driven. And I think that that's going to continue. Look, again, not to get so political, but if we have a shift in the political winds, that's going to be a huge boon for the older school economy stuff, and a little bit less regulation perhaps, and a little bit more, well, we need energy, and even the nuclear space, right? If you're really serious.
So you're seeing a potential catalyst being the change in the political establishment from the current party to the other party.
Well, so yes, I think that's an accelerant, right? That's certainly an accelerant. I would say that the overall trend, though, is slowly working that way, in my opinion. Like we already saw on the flow basis, we saw Larry Fink sort of throw in the ESG towel and, of course, jump right into Bitcoin because that's the next shiny thing to attract his money. But I'm not going to get into that. But for Larry Fink to say, I'm not going to play in the ESG space as much, means that most people who follow BlackRock, which is a lot, they're going to say, oh, I can now go outside of the formerly ESG blinders and pick up names that have been excluded, left for dead, ignored, villainized. So that's the slow motion direction, in my opinion, as is dividends. You got to have some dividends here. You got to have diversification. You got to have quality names, and you got to have stuff that nobody owns.
So I see. So you're saying there's just a natural tide shift that's taking place that was bound to happen at some point, and it's like moving the Titanic. It's slow, but then there's going to be various accelerants like the political shift that could happen, or something else that might come that would accelerate the shift that is already underway naturally. That's moving slow. And I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and every single expert interview that we conduct, just like this one. It's all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote, and it's based on the important Ray Dalio foundational premise titled, "If you don't own gold, you know neither history nor economics." This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us. Also, I'm positive that you've enjoyed this conversation with Mark as much as I have. Please let him know. Hit the like and subscribe button and leave a comment below the video.